do you think traders tend to hold on to losing trades? Is it wise to keep holding on to losing positions?
Up to a point, it might be. It depends. It depends on the homework you did before you went into the trade in the first place. It might be that you are happy to hold on to a losing trade because it's nowhere near your stop loss yet. That you've given yourself, a margin of error on a position that you've decided. Well, yeah, I'm pretty sure, by my calculations, this is going a particular way, but I'm prepared to take some pain of it, or prepared to sort of see it be offside for a while. So I'm going to run that. But hopefully you'll have a stop in place if it continues losing and you've done your risk management properly. So that's perfectly reasonable. We're not going to, you can't all sort of buy or sell something and immediately come into profit and carry on. Things are going to be offside from time to time. But the problem comes when you're in a position, maybe you were sure of your reasons originally, but now you're seeing that the things aren't panning out the way you hoped. You see a market and it's sort of coming off. It's coming off each day. The momentum is building to the downside perhaps, and you bought it originally. And maybe you started to move your stop down. Maybe you started to move your stop sort of further away from your opening price, so you're sort of losing more and more. And that's very debilitating. That's not good for you. It's not good for your risk capital. It's not good for your money management, but it's not good for your mental capital either. It'll get you down. So that is why there's a time to cut your positions, to sort of just say, right, enough is enough, forget it and go on with something else. So that is why I'd say don't change your stops. Once you've made it, don't change your stops. Don't move them further away and risk more once you put a trade on. Move them up by all counts to lock in a profit, but don't run losses.
What qualities separate winning traders from losers?
Well, it's market discipline as much as anything else. It's having a trading plan which can help you take the emotion out of trading. It's not running those losing positions and moving your stops further and further away and taking on more and more risk. So, it's having a trading plan, it's money management and risk management. It's being prepared, it's knowing that losses are going to happen from time to time and just sort of taking that on the chin and then going forward. But it's also a lot of hard work before you actually place the original trade. It's having the idea of the trade in the first place. It's developing that idea. It's looking at the fundamentals, whether it be the fundamentals of an individual company, so looking, and that means looking at balance sheets, debt levels, all kinds of stuff like that. Or why should one currency sort of outperform another currency? So there's all that fundamental work to do, and then it's going and looking at the charts because it's you might well be right. Over time, the euro might perform better than the dollar over the next 3 to 6 months. But if you go in and buy it today, you might be buying at a level of near-term resistance. And you might see it come off 1.5 cents before it starts going up again. So you've lost all that. And the only reason you sort of gave yourself a bad starting position was because you didn't do your technical analysis and look at the charts in the first place. So you've got to add all that together, and that's what gives you consistency. It helps you sort of take some of that emotion out of a trade, especially if it's offside. And that helps you be a successful trader.